It's time for Macro Monday, where the city's heartbeat meets the global economy. From Wall Street to the West Side, we track future interest rate moves, credit spreads, and national market shifts that shape New York City real estate. Fast, focused, and data-driven. Macro Monday starts now.
All right. Good morning, everybody. I'm going to say something new. Good morning, Aziz.
Good morning, Noah.
Thank you so much for joining. That's not John, guys. That is not John. John is away today, and I am honored to have Aziz Sunderji of Home Economics. This guy, sorry, can I talk about you in the third person for a second, Aziz?
I would love that. Noah. Go for
it. You are a machine. I've been following Aziz a long time. I am putting up his Home Economics blog right over here, his Substack, that you guys could subscribe to it. He talks about such interesting topics, and he has data and charts, and the way you design charts is so beautiful to give an actual takeaway. We're going to go into a bunch of that stuff here, but would you like to say just a couple of things, Aziz, about Home Economics, the Substack, and what you write about?
Yeah. So I put out a piece every day, Monday through Friday. It's all free. The Friday piece is only for paying subscribers, but it's only $8 a month, so it's virtually free. And I'm trying to write about housing, but everything related to housing, because there's so many things that are super interesting that are not exactly about the housing market, but that like people care about, and I think provide great jumping off points for agents when they're talking to their clients. So I'm talking about like home prices and how home prices are moving across the country and what's changing, but also like demographics and affordability and politics and all kinds of stuff. So I try to keep it, people don't have time these days, and I think they have, I find this, I just don't have limited bandwidth for like complicated stuff. Just keep it simple, just make it as simple as possible. And so I put out a chart. Hopefully people seem to like the charts. I spent a lot of time doing the charts. In my former life, I was a journalist at the Wall Street Journal, and I was a graphics reporter. So like my job is just making charts about the economy. So I've got a hopefully beautiful chart every day and a quick, pithy explanation of what it shows. And I'd love people to subscribe.
Yeah, you're wicked smart, and I love it. You kind of align with what we're doing here at UrbanDigs. UrbanDigs is very New York City centric. You're kind of across the country. I am just very happy to have you here, and you're going to be co-hosting Macro Monday with me while John is away. So I'm curious to get your viewpoint on credit spreads, Fed Fund futures, and then all the New York City beautiful charts that we have to show you guys. Guys, comments. If there's comments for Aziz, please ask questions today. Just put it out there, and I'll keep eyes on. Okay. In the meantime, guys, it's Monday. You're going to get a little Macro Monday coming right at you. I am Noah Rosenblatt with UrbanDigs. That is Aziz Sunderji over at Home Economics. And we're going to do a couple things. We're going to start out with Manhattan real estate over here, like we always do, in case you're new to this show, the format of it. We'll check in on our monthly trends. Then we're going to check out credit spreads. We're going to check out the Fed Fund futures. We'll look at some New York City charts, and we're going to try to wrap this entire thing up by 11:30 if possible. If you guys have questions, post it in the comments. Okay, please do. Other than that, don't start day trading. Whatever Aziz says about stocks and stuff like that, or I say, don't start day trading that stuff, guys. None of this is financial advice. Okay. With that said, guys, I am on the market ticker, market snapshot, 1 month right over here, new listing supply. 1,194 is where our 30-day pace is. You still got a lot of January in there, guys. This is 30-day ticker, so this is not really representing February, but we're supposed to be at 1,361 at the end of February. We're at 1,194, and it looks to me if we continue at this pace, we'll probably be above our new listings inventory. I don't know if you track Manhattan too deeply, Aziz. Do you, or in terms of supply?
I do from time to time if it's interesting. I dabble if it's interesting. Yeah. I feel like I'm trying to jump into whatever's interesting, and so like I've done a lot of work on like why people are leaving New York City, like what's going on there. So I right now I don't know if there's anything like super fascinating on the supply front. Like the whole market is just getting more normal. It's less chaotic than it was during COVID and in like the aftermath. I feel like everything's just settling down. So I haven't seen anything super interesting on the supply and demand front in New York City, but let me know if you're seeing otherwise.
I don't see anything. It just seems like it's a tight supply situation. And, this is the first time we're starting to see supply coming on. We got a season. That season starts in March, April, May. That's our listing season pretty much. So we're ramping up. That's all that's going on here. Give it time. Contract signed, 669 contracts that were signed over the last 30 days. That's supposed to be at 951 for the month of February. Aziz, I'm hearing a lot of stuff anecdotally about the market being active, but that just tells me that, bids are out there, due diligence, attorneys, accepted offers, negotiations. It doesn't have contract signed data yet. So this is kind of slow, and we've been a little weak here and there kind of a thing. I don't know if you know this, but Manhattan's been in a kind of a doldrums for about 3 years now in terms of contract signs post that whole pandemic craziness. And we just can't seem to shake it, Aziz. I don't know.
Yeah, it's not unique to this market. That's like, you're seeing that across the country. You had this like surge. One of the analyses I did a little while back is looking at I think every agent's wondering, like, why are homes not trading? And there's ideas about that. There's like mortgage lock-in and all kinds of other reasons. But when do we get back to normal? Like, what is this? Should I like get out of this business? Is this like a secular downturn? Is it going to be like a decade of homes not selling, or like, is this just a year or something? And I guess I have good news on this front. I didn't set out to report good news, but my analysis showed was my theory was that like we had a surge of transactions during the pandemic, and then you've had this like fallow period afterwards where everyone who wanted to move at any time in the next decade did that in like 2021 when mortgage rates were like super low and people could work from anywhere. So like you had this tidal wave of transactions, and then you've had a quiet period after that. These things tend to happen. You get like something going up and then it goes down for a little while, or like things are super active and they get very quiet. And the period of quiet we've had now basically makes up for that surge we had during COVID. So like we're back on the trend line. So my view for home prices is like, I don't think it's going to be great. And I thought I had a pretty like controversial view, but then it turns out this is kind of what everyone thought. I do think I thought this earlier than others, but basically everyone's calling for like 2 to 3% home price rises this year. It's like, that's below average. The average is like 5%. So it's lower than average, but it's like, it's not horrible. That's not great news for agents, but I think the good news is that transactions, I think, can pick up even if home prices don't go up a ton.
And that's the key, right? I mean, home prices could go up, down, sideways. Who cares? As long as the volume is moving. I think agents are looking at transactional volume, and that's what's just been so kind of weak. You can see on this chart right over here of our liquidity, it's in the low category. And I got a question from the audience here. Noah, if this is a 30-day activity, of course, you're talking about this contract signed 669 up here. Isn't it supposed to look at January data versus February? Great question. This is just a ticker, right? So if I go over here, this is just giving me daily bars for the 30-day moving window and showing me total contract signed. If you want to look month to month and year over year and all that stuff, I would go to the chart room. Let me just show you what I would do. I would go to the chart room, load that up, and I would look at monthly contract activity, and that will show you all those trends over there. This is just like, this right here is just like almost like a ticker, like a CNBC ticker showing daily activity, weekly activity, monthly activity. And I'm telling you that we're supposed to end February at 951. So we're light, but that's normal because this is like our rise up to spring season. So good question. Thank you very much. All right, Aziz, excellent point. Are you ready to move on to macro?
Let's do it.
All right, let's do it. Let's start with credit spreads, guys. Whew. I'm going to say credit spreads. I mean, we've been looking at credit spreads a long time. I don't know if you can even see it. Guys, this is at the same stage, but like if you were following this last week, this moved up to 2.1. Okay. Believe it or not, this updates every day. I mean, we're only a macro Monday once a week. This moved up to 2.1. You can see it right over there. Let me see if I can go here, right there. This moved up to 2.1 and then just came back down with Friday's information back down to 1.6. So even though we're at the same level we were last Monday, there's some volatility and fireworks going on with the markets. Aziz, what do you think about this? Credit spreads.
Yeah, if you throw up the stocks alongside, how close are those tracking each other?
Yeah, I mean, you take a look at more like a year chart. Oh, let me put that back up there.
Yeah, that's helpful. Yeah. So it's a modest rise. This is like nothing to freak out about, but it is interesting. Right. Like I think these rumblings in the market, both on the credit side and stock side, is like the narrative's changing very quickly, and this latest kind of like nervousness is clearly about like the market's been led by a handful of stocks that stand to benefit from AI, and the sort of the impact now is that I think folks are concerned about the broader tech universe and software companies in particular, and what AI what kind of impact it'll have on software companies. Because if this is the end of software, it's great for all kinds of people who want to build their own, personal software, which I'm doing on my side, and you guys should all be doing that using like Claude Code. But in terms of what it means for the stock market, it would be pretty worrisome. I'm sure everyone has a take. My personal take is that I think that's probably a little bit misguided. Software will still exist. The tech sector is probably fine. I know there's a lot of overvaluation in some components of the market, especially AI exposed stocks. But I think of myself as like a heavy user of AI and as a business user, and I don't think it's like overcooked. I really think we're in for like a sea change. Just a surge in productivity as people adopt these tools. So I know valuations are really stretched now, but I think they're kind of justified. So my if I were to like prognosticate, and no one should ever do this, about where stocks go over the next few months, I don't think this is the beginning of the end for the S&P 500 or credit spreads.
Right. I mean, when I look at credit spreads as a whole, there's not much going on here, but you really nailed it. I mean, this is a SaaS, software as a service, SaaS company, AI reset. I mean, it's almost like early days of Blockbuster and Netflix almost coming on, and Blockbuster just not seeing how there's a sea change going on in the world, and it just refuses to acknowledge and adapt. You just said that you're a heavy user of AI. I don't want to speak for the 120 plus people that are here right now. I assume a lot of them are agents in New York City real estate, but I mean, it's hard to be a heavy user of AI if you're a full-time real estate agent in New York City. Maybe people are light, maybe they're medium users. So when you say Claude Code, I don't even think a lot of people know what you're talking about. So could you just give me a quick dumbed down version of what you're talking about in terms of that?
Yeah, totally. So I wasn't in this world a year ago, but I heard rumblings about this Claude Code thing, and I was like, let me check it out. It has completely changed my business. It's changed the way I think about what we're headed towards, like what the future will look like. So I could talk about this forever, but in a nutshell, Claude Code is a coding tool that is produced by this company called Anthropic, the people who produce Claude, the chatbot Claude, and super simple to use. You just every computer ships with this thing called Terminal. You just open up Terminal. If you search for it, it's on your computer, and you type in Claude Code install, and then you're up and running with this thing called Claude Code. And you can just basically ask it questions. You can tell it, I want to build, say, a map of home prices in New York City, and I want you to use Zillow to populate that map and color things that are going up by a lot in blue and things that are going down in black. And it will make that map for you. And you can be like, well, I want it to see that over the past year, and I want to be able to zoom in and see how many people live in each place, and then make like forecasts about where home prices are going. Claude Code can do that all for you. I think this, as like people have cottoned on to how powerful it is, I think this explains why software companies are going down, because people are like, who's going to buy software? Everyone can make their own software. Truly, it is that easy. And I talked to like a lot of young people, some interns who are working for me and students, and this is my advice to them. And for agents, like, I'm super busy too. I've got like a little baby at home, and I'm like sleep deprived, but like Claude Code has made my life so much easier. I truly think that is like the most powerful business tool out there, including for agents. You can just there's a lot of agents out there and everyone's competing for business. You can be smarter. You can be better than the rest if you're using tools like this.
Yeah, and that's what it's all about, right? It's about agents adapting and using something that's maybe not in your comfort zone of where it's going. Now, I'm not telling you agents to go out there and become programmers and coders and all that. You can go down that rabbit hole, but there might be some use cases. There might be some stuff that's going on. And Aziz, you use this to create some of the charts I'm going to show today, I believe. So we'll get there shortly. Credit spreads, keep eyes on. It's moving up, coming down, but there's something going on in this whole SaaS world. Claude SaaS software. Take a look at some of those software stocks. It's like .com level. Some of these software stocks, it's like 60, 70, 80% in the last year or so. It's crazy. It all happened in the last few weeks. It's just nuts. Fed fund futures, guys. This is our interest rate portion of the program. Okay. We're looking at the Fed fund futures table. We are at this level, 350 to 375. We're looking at this table to tell us future Fed meeting dates, right over here. This is all the future, guys. That means you don't want to go too far out in the future because the percentages that these expectations get right go down. And we're in the intelligence business, so we don't want to sacrifice any of that. So if you're talking to a Wall Street client or anyone that's familiar with Fed and rates and you want to talk intelligently about what rates are doing, this is what you say. We are currently at the 350 to 375 level with the Fed fund futures rate. Okay. The next two meetings in March and April, they're not going anywhere. They're staying right in this column. 82% for March, 65% for April. No change. The first rate cut the markets are expecting is June. That's at 51%. So ask yourself, do you want to pin your advice on something that's a coin flip? Right? That's what I'm talking about. So just read the tape. Read the tape. Don't predict and prognosticate. The market's expecting a 1/4 point cut. These are all 1/4 points. 51% chance in June, 36% chance in September. Last Monday, that was October. Now it's September. So the markets are thinking maybe a sooner second rate cut. That's it. We stop right there. We don't really say anything else. Aziz, I don't know if you follow this or thoughts on rates or anything.
Yeah, I mean, I think like just to go super macro on this, like where is I think a useful thing to think about is because everyone has a view on the Fed, like, oh, I think they're going to cut, or like they're going to cut a lot or a little, and like the new chair and all this stuff, and that stuff is fun, but like I think it can distract you from like what matters. And so like you just like zoom out massively and you're like, where is monetary policy? Like what's the Fed doing to the economy right now? And what should they be doing? And like I think the easiest way to think about it is there's a rate that the Fed can set interest rates at that's kind of neutral. That's like not really stimulating the economy, not speeding it up and not slowing it down. We've come from the Fed applying the brakes, right? We had inflation kind of taking off and the economy was getting very hot and the Fed was concerned about that and asset prices were going up. So they raised interest rates a ton. We saw mortgage rates go up. And then they said, we've done enough braking. We're gonna let the economy run a little bit. And so now they've been loosening and we're pretty much like a way we can orient ourselves is basically by saying we're like pretty much back at neutral. Like now we are pretty close to neutral, maybe slightly just above it. And I think that's what explains the market pricing in 1 or 2 more cuts, because we're like, and even Powell has said, we're probably just slightly restrictive. But we're like, they're very close to being neutral. So I think that's a reasonable thing to expect over the next few months, that like there's like a couple more cuts and then they're kind of done. And the inflation is reasonably well behaved. Growth is pretty well behaved. The economy is just kind of like stable, and policy is likely to be, after these couple cuts, stable. And it means mortgage rates probably come down a little bit, but I don't think we should, like when you're talking to prospective homeowners and think about financing or refinancing, I don't see any huge reason to expect like much. We're 1% lower than a year ago. I think like this neighborhood we're in now is probably where we're likely to be for a while.
Yeah, and I think that's a good thing. I mean, there's not a lot of volatility on either way. Things are stabilized. If anything, they're drifting a little lower. And you made a point. You made such a good point. You made a lot of good points, but you made one specific point that Johnny and I talk about here often, which is that neutral terminal rate. Well, on the downside here, that neutral rate. And guys, if you recall, if you've been following Macro Monday, every Monday, you got to trip back about a month or two ago. And Johnny and I were talking about how we're right here now, 350 to 375. That's where we're at. But the neutral rate is probably somewhere. It's either here or it's here or it's here. Like it's one of these three. And all of them are neutral rate. They're neutral. They're neither stimulative nor restrictive. If the rates were to go all the way down here to 200, 220, that's stimulative. And you don't want that, because that means something bad's going on with the economy. And if something's bad going on with the economy, something's bad going on with the stock market, credit spreads are probably blowing out and no one's going to be buying Manhattan real estate. And that's how all of this is interlinked. So the idea that Aziz is telling you, kind of similar to what Johnny and I are saying, that we're in this neutral, we're trying to find out our neutral rate and we're close to it. That's a positive thing, in my opinion. So just wanted to point that out. I got a question, Aziz.
Yeah.
Here. Do you think the new Fed chair is going to be more aggressive, I guess more aggressive in what hikes?
Yeah.
If he's more dovish than
I don't know.
hawkish.
I think the thing that we might like. One thing I wonder about is what he'll do with Fed holdings of Treasury securities. I think that's like on policy, it's hard to say. Like I think he's historically been a bit on the hawkish side, but Trump's not a guy who likes high interest rates, so it's sort of hard to say. But I do think that like people might be sleeping a little bit on, like, this is not stuff that's like reported, in whatever paper, as a headline, but what they're doing on their holding, like, the Fed, central bank holds a ton of, there's a ton of treasury securities on the balance sheet
and mortgage-backed securities.
Yeah, both MBS and treasuries, and what the Fed does with that could really influence what happens to mortgage rates. So that's, but I don't have a clear answer on this one either, because
he's tight. He's tight on that. He wants to he wants to take liquidity out of the system, I believe. And
he's talking about how the Fed has like been getting closer to monetizing the debt and the deficit, right, which is something he's concerned about. So that would imply that he's going to look to reduce the holdings, which would push mortgage rates up. But this is an increasingly like politicized process, so hard to say.
That's a really good point. The Fed controls rates on one end, but guys, remember the Great Financial Crisis created a playbook for the Fed to manage all these problems. And in the process of getting us out of the Great Financial Crisis, they took on and basically became the lender of last resort. And they bought all of these assets, providing liquidity to the markets at that desperate time via permanent open market operations at the New York Fed trade desk. That's how they create money. Guys, that's how they create money. It's all computers and printing. And you give me this asset, I'll give you money that didn't exist before through in a balance in your account. It's basically what they did. And now they're holding all this stuff. Seems like Warsh might want to get that lower. And as Aziz says, it might make interest rates go up. We'll see. We'll have to keep an eye on that.
Related to this, one of the questions was, what do you say to a softening labor market? Have you guys talked about that on this call in the past? Do you have a view?
Yeah, well, the only problems we see are there's the lingering inflation on one end and a softening labor market on the other end, and that's all I see. So, what do you see?
Yeah, I don't know. We got NFP on Wednesday, right? It's a weird week. I saw the Goldman Sachs note saying that it's on Wednesday. I was like, what is going on? But it's because the government shutdown, right? Things are like all haywire now. So, but from what I can see, the street consensus is nothing dramatic, right? Like unemployment kind of holding steady. But yeah, for sure, those are the two sides of it, right? Inflation and the labor market. Looks like AI is the cause is one of the comments in the chat. I agree. That's the thing to watch for sure. Like in my business, I'm hiring less juniors than I would typically because I'm just much more effective at using AI for all kinds of stuff. And it's kind of sad because I don't know how these guys climb the corporate ladder. But yes, I think that's definitely the thing to watch.
Yeah. And it's crazy to watch the market reset in front of our eyes. And it's not really impacting the broader market indices. Well, maybe the NASDAQ a little bit, but it's the SaaS, it's the software sector. It's destroyed. It's crazy. All right, let's pivot. Let's pivot to macro. Aziz, this is Aziz. Guys, we're going to overload you on charts. We're in New York City. We start country, but then we're going to go right to New York City. We're going to overload you on charts. Aziz, take it from here. What am I looking at over here?
Yeah, so this is a chart showing year-over-year home price gains and losses by zip code. So each little dot, there's like thousands of dots there. Each dot is one zip code. Blue means it's gone up, and black means it's gone down. Or black means it's below average. And this is like year over year by the end of 2025. Things haven't moved a ton in the past month. And so big picture, I don't think it's anything that people aren't aware of, but just that the Sun Belt, Florida, large parts of California, not doing so well. The Northeast and New York City has been doing really well. So that remains like the case that this market is one of the stronger markets. It's that said, New York, like a year ago, New York City was pretty exceptional. It was like just ran the numbers this morning. It was in the 91st percentile of home price gain. So basically, New York was doing doing extremely well compared to the rest of the country. If we say well as rising home prices, which I think most of us do, that's changed. So there's been a huge deceleration in New York City, and so now it's kind of in the middle of the pack. It's not the strongest performer. I think it's in probably the lower end of the Northeast. But if you look at the whole the national market, it's kind of much closer. It's still slightly above average, but it's not the hot market it was a year ago.
Yeah, very interesting. I love these charts that you make. And New York City suburban flight. These next couple of charts I think are really interesting because Johnny and I don't do these types of charts. So I like the fact that we're bringing a little variety in here and you're talking about what's going on. Why don't you explain what this chart is saying?
Yeah, and just to the comment, when I'm talking about the 5 boroughs and I'm talking about New York City. So this is something that I noticed when I made that chart the map that I just showed you, is that when you zoom in on all these places, what's actually happening is that the centers of all these cities are doing not as well as the suburbs. So in New York, that means just not going up as much. In the Sun Belt, that means actually declining. So that the centers of these cities are really not doing well. No duh. That's been the case for a little while. We had COVID. People left the cities. They went to live in nicer places, cheaper places, whatever, get a bigger home. But the weird thing, this is what really surprised me when I ran the numbers recently. This is this is showing since January 2020. So if you look at where home prices were in January 2020, where they are now, they're kind of just barely up or flattish in Manhattan.
Flat.
Yeah. And Brooklyn, some parts are down, some zip codes are down, but then the further out you go, the better they've done. And then home prices in parts of Jersey and Westchester are up 50, 60, 70%. And the crazy thing is that I would have expected, okay, at this point it's 2026, people are getting called back to the office. Life is supposedly returning to normal or has already returned to normal. Actually, that suburban premium is stable. It's not going down at all. The suburbs are holding that gap. It's kind of,
I find the
I don't know what
suburbs, don't forget that thought. I find the suburbs around the Northeast stopped rising, and they've rose up the mountain, and they're just kind of chilling out at the mountain right now. They're not rising anymore, but they're not going down. I don't know.
Yeah, it's stable. It's stable. I would have thought if you had asked me what happens to this, if you go back 2 years ago, what's going to happen to this? I would have said, okay, it's going to revert back to normal. Manhattan will go up again, and suburbs will decline, and you're going to see exact reversal of this. But it's not been the case.
All right, guys, this is a portrait style chart. I apologize. I can't make this. If I make it bigger, it's going to kind of cut into it a little bit. I guess I can leave it there. But Aziz, tell me briefly what we're looking at over here.
Yeah, so I know this is slightly overwhelming visually, but basically this is just the distribution of home price changes year over year. And so if you look at the top ridge there, 2001, most of it is blue, sitting above zero. So that's just telling you that most zip codes were going up, home prices were going up in most zip codes. The sort of median looks like it's around 5% in that year. And yellow is the number of zip codes going down, and there was very few. And if you scan down the chart a little bit, look at 2008, there's a big yellow chunk, or 2009, big yellow chunk, and very little blue, because most zip codes had declining prices. And then scan all the way down to the bottom to 2025. That's where we are. That's where 2025 prices were. It was kind of a mix. It was there was mostly blue, so most zip codes went up throughout 2025, but you had a bunch that declined. And I think this explains how weird the market feels right now, because if you just reading headlines or talking to people, it's New York is going up, and the Northeast generally is going up, but then Florida is cratering, and the Sun Belt's doing this is not normal, right? This
No.
They're going in completely different directions. And I was is that actually what's happening? And I think it's not that weird of a market. What seems to be happening is just that the sort of the median is just very close to zero. And so even when you have a normal distribution, some places going up a little bit faster, some places declining a little bit or going up slower. When the average is so close to zero, you're going to have like a pretty even split between going up and going down. And so that's where we are right now. It's like the market is just very stable right now, and like it's not budging very much. And that's why we have like some going up, some going down, but it's not a crazy market right now. It's not like you look at 2008, there was like some places really going down a ton and some actually going up. And that was a crazy market. That was like, there was a huge spread between outperformers and underperformers. It's a much more normal market now. It's just that some fall on the plus side and some fall on the negative
More
side.
neutral. Okay.
Yeah.
New York City is growing again. Will it last? Domestic outflow slowed, international in-migration accelerated. Explain this.
Yeah, so I've been doing a ton of work on like New York City, what's happening in the five boroughs, why we're losing population, or have been for a good chunk of the past decade. And basically the story, this is like one of the charts. If you guys are interested in this topic, there's a ton on the Substack about it. But basically the answer is that New York's always had a loss of people to other states. You've had some net population change from just more people being born than dying. The big thing that has led to population growing back when it did was, and not creating more than it has recently, is that people arrive from abroad into New York. So, people tend to arrive from abroad and that boosts the population. We have some people being born as well, but then a lot of New Yorkers are leaving to go to the rest of the country. And what's happened over the past decade is that international migration has not been flowing in fast enough to make up for all the people who are leaving New York City to go elsewhere. And I've been trying to figure out who's leaving, why, where are they going, answer all these questions. It's super interesting. It's complicated. I do think it is very relevant for agents. So I don't know how much time we have. It looks like it's 11:31, but like just like a PSA that for people who are interested in the topic, there's like a ton to say about it, and I've written a whole bunch of it on that.
We're going to go a little over today, guys. We're going to go a little over. We only got a couple more Aziz charts here. I want to get through to this, and also if you guys have final questions for Aziz as well, now's your time to do it. But keep going. This is great.
Yeah. So there's basically two. Well, let me explain this bubble chart. So this shows who's leaving New York and where they're going. So each bubble is sized according to the number of people that it represents, and that the placement of that bubble on the x-axis represents the average age of that group, and on the y-axis, how much money they make. So basically, like, you see that blue bubble in sort of the top left, the one that's labeled young, high-income New Yorkers moved to San Francisco. It's a big chunk of people who are like relatively young. They're like 32 or 33 on average, I think, and they're earning like close to 100K. You have a big contingent of those people who are leaving New York City. That's a big chunk of it. Older people who are like rich are moving to places like Naples, Florida. And that's in the top right of that chart. And then in the bottom left, you look at like who's going to Syracuse, Buffalo, Binghamton, Albany. Those are like young people, probably mostly students going to state schools upstate.
Interesting.
So it's it's just like, it's super interesting. There's when people say like, oh, people are leaving New York because the taxes are too high, or because like, home prices are too high. It's complicated. And the first thing is that the people who move to the suburbs are different from those who move to like Texas. People who move to Texas or Florida or California or other states, they tend to be younger. They tend not to have kids. They tend to be high income, and they're mostly moving for jobs. And no, if you want to jump to the next slide, this is kind of what I'm talking to here. If I remember what's next, actually, sorry, go one more.
Did I not?
Or do you have? Maybe we don't have it. Okay, never mind. Okay. But basically, there's another chart I thought we had that basically shows you why people are leaving New York City, and splitting that between those who are going to like other states and those who are going to the suburbs. And so I've just told you about the people who are going to other states. That's what these bubbles are. If you go on the Substack, by the way, it's homeeconomics.substack.com. Somebody was asking for the link.
Well, here's a question for you real quick. Do you get the visuals with the paid subscription in the Substack?
Yeah. Oh, you want that? Yeah. I mean, I haven't, that's not a thing. No one really asked me that, but I'm happy to share the visuals. Yeah.
Cool.
Yeah. People who are moving to the suburbs, basically, I'll end on this one. It's home prices. There's a problem with home prices at current mortgage rates. It's too high for most people. It's like not news to anybody, I guess. But lots of people moving to the suburbs, they just can't afford to live in Manhattan or Brooklyn.
You're getting some really nice comments, and this is why I wanted to have you on here. And when Johnny was like, "I'm not going to make it on Monday," no, sorry. I'm like, Aziz, give me Aziz. This is just great stuff, guys. I'm so happy that you're liking these charts and this different change of pace. One more slide here, Aziz. Low rates of household formation and marriage explain a lot of the millennial boomer homeownership gap at the age 30.
Yeah. So basically, like my view is that if you look at how the home ownership rate for young people, it's a lot lower than it was for people in prior generations. So this chart looks at millennials versus boomers. The big reason, what this chart is showing is how people flow from birth to getting married, to forming their own households, to getting married, to buying a home. And so I took all the people who are born, and the cream color is for boomers and the blue is for millennials. And I'm comparing how those two generations flow into home ownership. And so you can see right off the bat, like back in the day, when boomers were in their 20s, so this is like the 60s, I suppose, most of them by age 30, this is all showing age 30, most of them by age 30 had moved out of their parents' home, and they had formed their own household. So they could be renting, they could be owning, but the point is that they're not living with mom and dad anymore. They're not living with friends. They are household heads, or the spouse of the household head. This is a huge difference. Today, young people, a much larger chunk of them, 31% of them are staying with their parents because they want to. Maybe probably also affordability is a huge problem. So they're just staying at home until they have enough money to move out, or they're living with friends. In either case, they're not a household head. They're not on like the home ownership track. So that's one like huge reason that boomers owned more than young people today, is that they're just not, young people today just aren't moving out of their parents' home. And the other one, and I think like maybe affordability is an underlying driver, but I think this is partly cultural because this is happening all over the world, even where home prices aren't insane, is that people just aren't getting married as much these days. Boomers got married at a really high rate, even by age 30. And young people just aren't to some extent, and are doing it later. And so what we tend to see is that when people get married, they tend to also have kids. They're much more likely to buy a home if they become married. If they remain single, much less likely. And again, affordability, people like yell at me, they're like, dude, it's not about marriage, it's about affordability. Like, I'm not denying that, but these are the flows that we tend to see. Do we think they're living with family, friends to save up to purchase a home? I think so. I haven't answered that with numbers, but that's my sense. If you look at this, I did an analysis last week at 35 and at 40. And it does change. Like millennials do start to look more like boomers when they're 40. So part of it is just delayed. So to your question, yeah, I think like they're probably a good chunk of it is just people choosing to live with their parents a little bit longer, or with housemates until they have enough money to put down a down payment or rent a place that they like.
I got some more questions.
John, what's this question? Do you also think the nature of John equals BS was unstable for baby? Oh, yeah. Jobs. Okay. Yeah, probably. I mean, this gets back to like what we were talking about AI and like young. If you look at like the unemployment rate for young people, it's going up, and yeah, the tenure of jobs is going down. There's more gig work. It just takes longer these days to establish yourself. And like the other thing is that way more people are living in cities now than used to be the case. A lot of boomers lived in like smaller towns where things were more affordable, but like people live in New York City, they live in San Francisco, they live in LA. Like these are really expensive places because the economic opportunity is really high. And so that's another reason that like I think this whole delayed adulthood thing, I think that's part of it.
Firing is more the norm for companies than in the past.
Yeah, especially if you compare it to like 60 years ago, for sure. Yeah,
fascinating. This is all real interesting, guys. I think we've reached the end of our show here, but Aziz, I hopefully I speak for a lot of the people that are here. You added a nice little flavor to the show today, and those charts were fantastic and excellent thoughts on the market. So I want to take a second to thank Aziz Sunderji of Home Economics. Let me just go to his blog. This is what it looks like, guys. I'm going to do it again. I'm going to take a second. I'm putting it in the comment thing right over here in case you guys want to sign up for his Substack. This was fantastic. I am Noah Rosenblatt of UrbanDigs, guys. Tomorrow, I'm going to be talking about just if you're confused about credit spreads, if you're confused about the Fed fund futures or what we talk about here on Macro Monday, tomorrow we're just going to talk it out in a very slow, easy fashion. It's just to kind of get up to speed with this show. And we'll be doing this every single week. We got to get you on more often, Aziz. You are awesome. Thank you.
Thanks,
yeah, awesome. Thank you guys. And I'll catch you guys next time. Cheers, everybody.